So maybe you can share with us 3 of your biggest learning experience for the past 17 years so that at least we won't repeat the mistake that you have done.
No, you're going to repeat, you're going to make the same mistake. Don't worry about that.
Hello everyone. Today we are very blessed. We are able to actually invite a very special guest, well-known value investor all the way from India, Mr Vishal Khandelwal. And he is a teacher and practitioner of value investing and has been investing for the past 17 years.
Yeah, that's right.
And has been teaching value investing to people around him for the past 9 years. So once again, welcome Mr Vishal.
Thanks Alex.
Welcome.
Thanks, India.
Probably the first question is, can you probably share with us and the viewer out there some of your story, your background, how do you actually get started investing, and probably how's your result so far after 17 years?
Okay, so investing has been like a series of accidents for me.
Accident?
Yeah, a series of accidents. Actually, I got into the stock market as an analyst in 2003 because that was the only job available after doing my MBA. So got into there, and luckily I got working with an independent research company. We were purely doing research. We're not at a broker, so there's nothing that I was doing which was short term. Learning the principles, learning the power of long-term investing actually started getting ingrained over that time. So again, another lucky incident for me. And then 2006, a friend of mine actually gifted me this book called The Intelligent Investor by Ben Graham. Initially, I did not really, I found the book a bit tough, but then I think someone suggested that if I read a couple of chapters, this is chapter 8 and chapter 20, right, specifically of that book, and I actually really got hooked into that thing. And then gradually I started reading about Buffett and Munger from Graham, right? That really interested me. Of course, I was practicing long-term investing in my personal life as well, and also as my job as an equity research analyst. But getting into the idea of what value investing is all about, the power of value investing and how actually you can create wealth over a long period of time, got ingrained during that time, 2006 onwards, right? So I would say I think I really got into the idea of value investing and have not really looked back after that. So.
I see. Very good, very good. Yeah. So how to determine the value of a company?
So there are various tools and techniques. I would not really want to go into the depths of that because most tools and techniques don't really work for all kind of investors. The idea is to keep it simple, right? So if I were to look at some numbers that really help me in assessing the kind of intrinsic value that a stock or a business may have, one of the number which I look at is the cash flows. If you can assess the free cash flows of the business, and there's something called as the discounting factor, so you discount it. So doing a DCF kind of a model, if I were to use that complex term, discounted cash flows, you assume the cash flows for the next say 10 years and you discounted them back to the present value. So this is one tool which I use, not much, but I think the idea, as I mentioned, is to keep it very simple. If you can understand the business, right? If you know what you're getting into, if you are fine with the management quality, you need to calculate valuation approximately. It's like back of the envelope calculation. You will know what is the approximate value of this business after calculating some numbers, but just understanding the business. You don't need to use complex Excel models to do that, because the more complex things that you use, you're going to forget after 1 year what you actually did. And there's a great chance that you're going to go wrong because you're using mathematics to justify a qualitative decision making, right? So I don't really believe in complex mathematical calculation to arrive at valuation, but I try to keep it simple, and it is mostly an approximation, and it's a range of values. So just to give an example, if I were to say the value of Apple is in the sense people would say the target price for Apple is say $1,000, right? I would say when I'm looking at valuation, I would say the valuation of Apple is somewhere between $800 to $1,200. It's always a range of outcomes, always a range of value, and not a specific target. So that's the way I look at valuation. I keep it simple.
I see. Do you have any financial ratios or financial red flags that when you see these particular financial matrices that you will want to avoid investing in companies like totally?
Yeah, so I think not many ratios. Again, I look at the debt to equity ratio, for example, the debt on the balance sheet.
So what is your benchmark for that?
Yeah, so for me, I am generally looking at zero debt companies or a maximum say 50% debt to equity, 0.5.
Oh, 0.5.
Yeah.
So you have been investing for the past 17 years, right? I believe you also have your own learning experience. Right? So maybe you can share with us 3 of your biggest learning experience for the past 17 years so that at least we won't repeat the mistake that you have done.
No, you're going to repeat, you're going to make the same mistake. Don't worry about that. We say we want to learn from others, we actually want to make all the mistakes ourselves, right? So one of the biggest mistakes which I have made is to not buy businesses which again, it's a hindsight bias, right? Perfect vision 2020. But in hindsight, I would not try to make that mistake again when I know a company is high quality and I am fine paying a reasonably decent price. I cannot really wait for a cheap price, because this is something which I did. I waited for extremely cheap price to buy a high quality business, because in today's world you don't get cheap prices for high quality businesses, right?
So about fair value for
fair value, near fair, I'll not go for a 30% margin of safety. I'll probably buy it at the market price, right? If there's some, even say like 5% margin of safety. But I'll rather look at high quality businesses, high quality managements with reasonable, consistent numbers over past many years and a growth potential. So past is good, but the company has to grow over the next 10 years, 15 years as well. So some reasonably amount of growth that if I can assume for a company, I think that makes a lot of sense. So not buying high quality businesses because I was waiting for cheap prices was one of the mistakes which I learned. The second was not holding on to high quality businesses for a long period of time. So which I've learned over the last many years now, and I practice a philosophy of buying and never selling. So my idea is to buy and never sell. And when I say never sell, it doesn't mean you are blind to everything. What I'm saying is you buy, you review every year, and if things are fine, you just keep on. Even if the stock has given you a 10 times or a 5 times or a 60% in 1 year, it's not about where the stock has come from. What matters is where is it now, the business is now, and where is it going to go 10 years down the line. Not where your cost price does not matter, right? What matters is today versus the next 10 years of cash flows and everything, right? So I've sold stocks in the past pretty early in the sense like 2 years, 3 years after making some amount of money or after making no money, thinking that this is okay, the stock is not going anywhere, let's sell. And after that, I've seen stocks multiply, right? Of course, because the business was doing well. Okay, another mistake which I made, buying one bad business was like way back in 2006-7 when I bought a hotel company in India, thinking that amazing hotels and booked for next six months and they're charging high prices and making a lot of profit. But the fact is that I forgot to look at the balance sheet. So balance sheet was huge on debt, right? A lot of borrowings on the balance sheet, right? So not reading the financial statements and not reading balance sheets long time back, in the sense 10 years back, was another big mistake which I don't repeat now.
So for the next 3 to 5 years, in your personal point of view, which are the top investment trends that as an investor we should pay attention or focus or emphasize, like for example AIs, autonomous car, AR, VR? Yeah, what's your point of view that these investment trend you personally also don't want to miss out?
So I think of course there's a lot of disruption happening, a lot of technologies coming in, and most of us have no idea about what is going to come, right? I believe in what I think Jeff Bezos, Amazon founder, he said so often. He said that if you want to do well in life, you need to focus on things which are not going to change. If we focus on things which are going to change, we have no idea, right? And he gives an example of say Amazon. He says that even 10 years back people wanted cheaper prices from Amazon. Now they want cheaper prices, and even 10 years later they're not going to say Amazon, I want to buy expensive stuff, I want cheaper stuff, even 10 years. So that is not going to change, which means Amazon needs to work on cheaper prices always. 10 years back they wanted faster deliveries, now they want faster deliveries. 10 years later customers are going to ask for faster deliveries, which means that is another thing which is not going to change. So if Amazon can work on cheaper prices and faster deliveries and customer satisfaction, they're going to do well. AI and technology is only a facilitator, right, for achieving that goal. As far as we as investors are concerned, even if you are working in the technology industry, most of the time you have almost no idea of where the technology is heading, what can come up, which company can do well, right? So having an exposure to those kind of businesses, I would really put a very small exposure over there. I would rather invest in companies from the technology space who have actually proven themselves. Just to give an example, like people like Apple, right, the more of a consumer business than people like Amazon or people like Facebook and all those kind of things, Alphabet, right? So I would still look at those established players who are large enough, because I see that they still have an opportunity to grow and do well for shareholders over a longer period of time. Otherwise, I would again focusing on things which are not going to change. I think consumption-driven stories, right? People are buying simple stuff, right? Old age stuff, right? Companies are manufacturing and selling again. There's a lot of competition over there as well. A lot of small companies with small brands which have come in. But I think companies with good management, they're going to do well over in the consumption space as well. Another thing, I'm not sure, maybe automobiles. Automobiles are going through disruption. We are looking at driverless cars, electric cars, right? But automobiles, large companies especially, they also benefit from distribution. So if I were to look at some Indian large automobile companies, I would also maybe think that is a good advantage, because more and more people who are shifting to urban areas need mobility solutions. Of course, public transportation needs to improve, but in countries like India, it's not really improving that much, right? So personal public transportation, cars or motorbikes and all those kind of things, they still have a lot of growth to achieve. Maybe media, banking, especially because a lot of people coming back to urban areas and a lot of people even in rural areas like smaller towns, they are using a lot of financial products. They are starting to use banking and all those kind of things. So again, established players in the financial space, established player in the media industry, because more and more people want to get entertained, they want to consume media. These are broader themes which I would keep an eye on.
So I think that's it for our session today.
Thank you, Alex.
For those people that are actually watching this video right now, I hope they actually benefited a lot and learned a lot from our very experienced investor, Mr. Vishal here. And I do see you in our next video. Bye-bye.
Thank you.